Hello and welcome to a CMS Forex Daily Market Recap. I'm your fundamental market analyst, Nick Nassad. Today is Tuesday, May 25th, 2010. The dollar-yen gained sharply overnight as concerns that the Eurozone sovereign debt crisis would infect the financial sector, combined with worry that tensions were escalating on the Korean peninsula, which led to investors abandoning riskier assets and moving towards safe havens. In a look at the euro-dollar pair, we saw that we came close to testing our 4-year low from May 19th around the 1.2150 area. However, we did find some support around the New York session at the 1.2175 area, and we did see a counter rally in later New York trading that brought us above the 1.23 level. Over the weekend, we saw Spain having to take over a failed savings bank, which sparked fresh concerns over the state of Eurozone economies and led investors Monday strongly out of the euro, which we saw extended in the overnight session on Tuesday. We had the IMF issue an unusually blunt warning to Spain that it needed a radical overhaul of its labor laws, a bold reform of its government pension system, and accelerated consolidation of its banks to stave off the kind of economic problems that have undermined Greece. So the focus now has turned from Greece to Spain in terms of the banking sectors. Equities in Europe were sharply lower, and that translated to a sharp 200-point open for the Dow Jones Index, though it did manage to claw about half of those losses back in later New York trading. The LIBOR rate, the rate that banks charge each other to loan money, spiked to its highest since last July, which certainly signifies that the credit is slowing in an interbank basis. The market is trying to price in a worst-case scenario right now, not only a lending freeze, but also of a major bank becoming insolvent. So that is where our risk aversion came from, at least in overnight trading. So while we did have this counter rally during the later New York session, it may just be a correction or retracement to this downswing before traders reload and sell the euro yet again. However, this 1.2150 area is very important to monitor, and we'll see if the ECB, for instance, does not intervene in the markets in order to prop it above this level. The euro-yen pair, meanwhile, plunged to its lowest level since October of 2001, though here too it managed to cut some of its steeper losses in the later New York session. The yen was stronger overnight on increased tensions between North Korea and South Korea, as North Korea's military accused the South Korean Navy on Tuesday of trespassing in its waters and threatened military action in response, which led investors already nervous over the eurozone to move out of riskier assets. Zooming this pair out, we saw a very sharp slide several weeks ago when we had the flash crash, but we could see that now we are probing even below the lows we had set back then in May 6th around the 110 level. The moving average picture is very negative, and we see that downtrend in this pair, so we would need to see perhaps a test and a move above the 200 period moving average before we can say that this pair is ready to retrace some of these sharper losses we had seen during the month of May. Look at the dollar-yen pair. We saw the yen gaining overnight, but here too we saw the dollar pair some of its losses, and here we saw that we stayed within the range that we had seen on Friday, so a bit of consolidation in this pair. So that's different than the euro-yen, where we actually went below our recent lows. Here our support around the 89 level did hold, with 89.25 being our low for today. Now the dollar did gain against most of its other rivals, especially higher yielding commodity currencies. So let's take a look at some of those. So during our overnight session, we had a very heavy risk aversion, and we saw that the US dollar Canadian dollar surged all the way to the 1.0850 level, which moved us above this very important 1.0750 level, which had been our resistance for the last several weeks. But also, if we move to a daily time frame, we see that that level was an important resistance from February and even in December. So today was the first time we moved above that level in 6 months. Now Canadian dollar did pair down its steeper losses to the greenback, but with equities and oil prices pressured, we'll need to have those dynamics change before the Canadian dollar can have any strength again. The focus on the weakness in Spain's banking system will continue to discourage demand for currencies related to growth right now. The Australian dollar also slid overnight, falling from its resistance around the 0.8340 level, though it did hold to its support here around 0.8060, which we saw in last Friday's session. Now again, similar to our other pairs, we did have the Aussie pairing some of its sharper losses in the New York session, as we did have a better than expected consumer confidence report, and US equities managed to pair some of their losses. In the US, the Conference Board Consumer Confidence Report for the month of May surprised forecasts by rising to 63.3, which was the highest level in nearly 2 years. The measure of present conditions increased to 30.2, the highest since December of 2008, while the gauge of future expectations surged to 85.3, the highest since August of 2007. That continues a rise in consumer confidence in this index seen over the last 3 months. We can also see that that has translated to higher retail sales, here measured on a percent change on a year basis. So that should bode well for the reading for May as well. The reason for the increase in consumer confidence was raised expectations that hiring will pick up in the coming months. In the second report, we had the Standard & Poor's Case-Shiller House Price Index, which covers the 20 major metropolitan areas, increased 2.3% from March of 2009. That was lower than the consensus forecast from economists. Federal tax credits have succeeded in propping up home sales and prices, though that raises concerns that the expiration of the government support on June 30th will spell another round of losses. Any sustained recovery in housing hinges on maintaining and deepening job growth in the world's biggest economy. While housing prices were up compared to a year ago, in the first quarter of 2010, the house price index was actually down 3.2%. And it might be a little hard to make out in the chart to the right, but we can see that the index, after rising in late 2009, has begun to see prices decline yet again at the turn of 2010. So currently, housing prices are at the same levels they were in the spring of 2003 back here on this in this chart. The dotted line is price change, and we see that we've come a long way after hitting a record low of 18.9% decline in this first quarter of 2009. So the actual positive readings are looking in a comparison to very low levels that we had seen 1 year ago. So while the end of the tax credit may bring about another round of housing price declines, which would be a negative for the housing market, that may come in a few months still, as the increased sales in May and June can still help to prop up prices in the near future. So that's our market highlights and fundamental releases for today. Let's take a look at the upcoming fundamental docket. Tonight, the Bank of Japan will post its meeting minutes as well as the Corporate Service Price Index. Australia posts its Melbourne Institute Leading Index. Overnight, Germany posts a measure of consumer confidence, and we have a tentatively scheduled UK measure of mortgage approvals. Tomorrow in the US, we have 2 releases, durable goods orders at 8:30 a.m. as well as new home sales at 10 a.m. And that will do it for today's broadcast. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you good trading.